Hello and thank you for joining us again on Capital Markets, live from Channels Television. I'm Temple Ashaju. Well, the Debt Management Office this week reported that Nigeria's public debt stock grew by 2.38 trillion naira, or 8.3% on a quarterly basis, to 31 trillion naira in the second quarter of 2020. Now, the increase stems from a 1.21 trillion naira and a 3.36 billion dollars budget support loan that we got from the International Monetary Fund, and a new domestic borrowing, which was also part of this whole pie. That aims actually to finance the revised 2020 budget, and it's put at 666.76 billion naira. Other contributors include a 162 billion naira sukuk and some 255.42 billion naira promissory notes issued to settle the claims of non-oil exporters. Now, that may be all for that quarter, but Nigeria is not done taking loans. This is because another multilateral loan of $1.5 billion is expected from the World Bank, while the AFDB, that's the Africa Development Bank, is also expected to grant Nigeria a credit facility of $211.5 million. And that's aside the Islamic Development Bank's $113 million loan, also expected to fund the country's budget for the rest of the year. Besides these facilities is the balance of domestic borrowing of about 588 billion naira, and of course some 200 billion naira to some states' government. But let's make sense of these borrowings now with the Managing Director of AfriInvest Securities, Ayodeji, who will be telling us how this could change the paradigm for us in the country. Okay, I understand that we really do not have him yet on the show. So in the absence of Ayodeji on the program at this point, let's quickly review the market figures as they came in from the stock exchange this week. We'll start, of course, with the top line, which is the all-share index of the exchange, which is, of course, a decline of 0.05% for the week to date. That's how we settled. We lost some 7.1 billion naira this week, bringing down the year-to-date performance of the markets to 4.7% after it had actually coasted beyond that level at some point. And now we have the equity capitalization of the market at 13.351 trillion naira when we discount the 7.1 billion naira week-on-week losses. Looking at the activity level, we closed at 1.22 billion in terms of the unit of shares that we traded for this period, and that's compared to last week is not too impressive. That's why you have the color red on screen. And Zenith Bank actually contributed to the transactions that gave us this figure for the week: 125 million units of Zenith Bank shares, and of course UBA's 104 million units of shares, and some 101 million units of FBN Holdings shares were all traded, aside other numbers and units of shares that were traded during the week to come in at this point. Value of transaction was also down to 10.84 billion naira compared to 10.94 billion for the preceding week. And Zenith Banks contributed more to that as well. Whopping 2.1 billion naira exchanged across the counter of Zenith Bank, GT Bank 1.2 billion naira, and MTN did 718 million naira, while in total we had 19,529 deals across the markets for this week. We're happy to have Ayodeji, the Managing Director of AfriInvest Securities, joining us now to discuss Nigeria's debt stock, which is now at 31 trillion naira. And we do know that this is not like the final figure for the year. We understand that there will still be an expansion of some 4.8%, having seen some 8.3% expansion between the period of April and June this year. Ayodeji, thank you for joining us on the program. To begin with, what's your understanding of the rationale for the 8.3% jump in our debts for the Q2 2020? We then saw the economy contracting by 6.10% for the same quarter.
Yeah, thanks for having me.
Sure.
I think we were all expecting this. If you look at it based on the impact even the devaluation will have on our external debts. If you look at the percentage of external debt as a proportion of the total debt, that's also increased. We got the $3.4 billion, about 1.2 trillion from the IMF. And when you look at the implication of the devaluation from 306 naira to a dollar to the current 380 to a dollar, but based as at Q2, let's if we assume 360, so you will see that's about 40% jump. So what we saw, we know in the COVID year, the revenue of the government has been impacted significantly, declined close to about 60%. So which prompted their need to raise more debt to be able to finance the budget deficit. So by and large, the major increase that we saw is can be likely attributed to two major factors: the devaluation impact, as well as the need for the government to finance the deficit. There was an increase in borrowings domestically by about 15%.
Yeah, I know that you're an analyst, coupled with the fact that, of course, you're the MD of AfriInvest Securities. But tell us, what do we understand about what the proceeds of these funds were actually used for?
Yeah, based on the performance reports published by the Budget Office, we know for the majority of these borrowings were used to finance, were used for recurrent expenditure, which is always the major concern. If you look at the debt servicing ratio to revenue, you will look at it's close to about 79% for as at May. So which shows that what is left to be able to finance the budget, both the recurrent expenditure as well as the capital expenditure, is really minimal. So for most of the borrowings that government has been doing has been channeled towards recurrent expenditure. Yes, there were some major funds that were released for capital expenditure, but we always know that capital expenditure is always at the receiving end once there's constraint in revenue. So for most of the proceeds of the debt mostly were used for, we can say, were mostly used for recurrent expenditure.
So, Ayo, I know you know that we're yet to actually be in receipt of other funds that we're expecting, other loans that we're expecting from the Africa Development Bank, some $211 million. We're still anticipating the big one, $1.5 billion from the World Bank, which, of course, the government has been fully bracing up for in recent times, given all of the reforms that we've been seeing across electricity tariff and, of course, the exchange rate unification measures of the central bank. But tell us, where will all of these lead us to at the end of the day? Will we still be able to have a sustainable debt environment? Because as it is right now, we're doing some debt to GDP ratio of some 21%, and we know that 30% or thereabouts is supposed to be the practice. We also know that some of the AMCON bonds and, of course, the treasury bills and some other measures that the CBN takes are not factored into this picture.
Okay, thanks. It's interesting. We all know that based on current reality, debt sustainability, it's really a very tough one. And majorly because of the major challenge in revenue. So when you look at, we are projecting that if you even look at total debt servicing as a proportion of revenue, would maybe close to 80 to 90% at the end of the year. So for most of these multilateral loans, the implication that we also see is that the devaluation impact would also be very significant. Would be significant on servicing these debts. So by the time we were able to get we assess the World Bank loan as well as the AFDB loan, by the time you are converting it to Naira at the end of the year, you would see that would have increased our public debt stock by that very significant amount at the end of the year due to that devaluation impact.
Okay, so you mentioned debt servicing. I know that the equivalent of what we have now compared to what we have right now in terms of the debt stock for the first 6 months of the year is like 10.7%, similar to what we had in the first 6 months of 2019. But given the low yield environment at this point, Ayo, can we say that we now have a lower cost of debt servicing?
Yeah, I think it's the when you look at the proportion of what has been raised this year relative to the total, when you look at it relative to the total debt portfolio, it's the impact. Yes, for the current fund or current debt, that's the cost of raising those debts has reduced significantly. But the
Great.
impact on the overall portfolio, I don't believe that will be very significant. But for governments, it also makes sense based on the low yield environment to take advantage of that. We can see government earlier this year changed their strategy from borrowing abroad to also trying to see how they can increase out their borrowings in the domestic market, which has also paid off due to the low interest rate environment. And when you check, we look at liquidity, we still expect close to about 5 trillion liquidity in terms of you look at that of coupon payments, you look at it in terms of OMO maturities, and even for the CPs, that's very significant. So, and what government has raised so far is about 2 trillion, and what they still need to raise is less than 1 trillion. So we believe that with the interest rate environment remain very low, and government, for them, it's good they are coming to the market at a very low rate.
Ayodeji, during the course of the week, some of your colleagues in the investment bank space, that will be FBN Quest now, put out a report and they projected that this Nigeria will actually return to the Eurobond market sometimes in early 2021. They gave their reasons quite all right. But do you agree with that projection, Ayo?
No, I think early 2021 will be an early call. If government is able to access the World Bank loan as well as the AFDB loan, there's, because of the high liquidity in the domestic market and the current rate environment, it's more prudent for us to focus and access those funds locally rather than going abroad. You still, when you look at the risk premium that will still be paid, you look at the crisis in the global space. It will be very significant. So if you are trying to borrow at almost 7 to 9% foreign loan, by the time you bring the impact of devaluation, you would see that it makes sense for you to exploit the domestic option. And when you check based on the strategy of the DMO to have external debt at about 40%, they are currently around 39%. So I feel that the focus next year would be more of borrowing within the domestic market, given that the liquidity in the system is also very high and the interest rate environment is also favorable for the government.
All right, Ayodeji Ebo, Managing Director for Afrinvest Securities, thank you for your insights on the program and thank you for making our time with us on the program this weekend. I appreciate your insight.
Thank you.